Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Cosco Shipping Ports Limited Annual Report. Cosco Shipping Ports Limited offers a diverse range of businesses and services to cater to the needs of its customers. At the core of its operations are ports and terminals management, where it operates container, iron ore, container freight stations, rail, and container terminals across various locations in mainland China, Hong Kong, Europe, and internationally. In addition to port management, the company provides a variety of services including financing, treasury management, logistics consultancy, container stevedoring, storage, inspection, and auxiliary services. These services are designed to support the smooth operation of its ports and terminals, as well as provide value-added solutions to its customers. The company's extensive network comprises 39 ports with a total of 375 berths, boasting an impressive annual handling capacity of approximately 124 million TEU. This infrastructure enables Cosco Shipping Ports Limited to offer a comprehensive range of services that cater to the needs of various industries and customers. Cosco Shipping Ports Limited market capitalization of $25 billion is materially smaller than most of its industry peers of roughly $39 billion. And Cosco Shipping Ports Limited trades at a higher price-to-earnings ratio of 8 times and a lower price-to-book ratio of 0.5 times relative within the industry. This shows that investors are pessimistic in the industry in general, and we should dive deeper on the reason. Additionally, the stock appears attractively priced. Investors should evaluate if the business earnings is sustainable and if the assets are valuated rationally. Overall, we need to identify if this makes a good investment on the long term, or is it going to be an extended period of low valuation or a value trap. The company maintains a moderate leverage profile, with liabilities making up 41% of total assets, suggesting a balanced approach between risk management and capital efficiency. Average liabilities have declined over the past 5 years, indicating improving balance sheet discipline and reduced financial risk. Shareholder equity has expanded consistently over the past 5 years, with growth supported by rising operating income. This suggests the company is profitable and financially sustainable. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The company have a dividend yield of 4.77%. The income statement shows that the company have been growing its revenue annually and the operating income have been increasing. This shows that the business model works and the business is expanding. The primary drivers of revenue growth or decline in the container terminal industry are multifaceted and varied across different regions and terminals. On the positive side, an increase in throughput has been a significant driver of revenue growth, with notable examples including mainland China's plus 2.6% growth and Europe's plus 13.1% growth. The full commercial operation of CSB Chenke Terminal has also led to a substantial 3,385.4% year-over-year (YoY) increase in revenue. Rate hikes have also contributed to revenue growth, particularly through increased throughput and storage income. In contrast, some terminals have experienced negative impacts on revenue growth due to changes in container volume structure and decreases in other extended business. For instance, the Xiamen Ocean Gate Terminal saw a minus 1.5% YoY decline, while Tianjin Container Terminal suffered a more significant minus 2.9% YoY decline. Notably, some terminals have bucked this trend, with CSB Zeebrugge Terminal experiencing a plus 22.8% YoY growth due to increased throughput, and Piraeus Terminal achieving 16.7% YoY growth. Guangzhou South China Ocean Gate Terminal also saw a 13% YoY increase in revenue. These variations highlight the complex interplay of factors influencing revenue growth or decline in the container terminal industry. The net income of the company underwent a significant change between 2024 and 2025. Initially, it decreased by $15,569 from $59,245 to $43,676 in 2024. However, this trend was reversed in 2025, with an increase of 7.3% compared to the previous year. The profit margins also experienced a decline during this period. The gross profit margin dropped from 27.8% in 2024 to 24.9% in 2025, while the operating profit margin decreased from 17.7% to 14%. This resulted in a YoY decrease of -2.1% in profit margins. These changes indicate that the company faced challenges in maintaining its profitability during this period. The company's debt level has experienced significant growth over the past period. According to the financial reports, the total outstanding borrowings have increased from $3,114,481,000 to $3,239,393,000, a rise of $124,912,000. Additionally, the company's debt level has also been boosted by an increase of $762,043. However, the interest expenses have shown mixed results. On one hand, the actual dollar amount of interest expenses decreased from $194,029 to $179,488, a reduction of $14,541. But on the other hand, the percentage of interest expenses has increased significantly from 8.9% to 27%, indicating that the company is paying more in interest relative to its total debt. The performance of various segments and regions within the company has been inconsistent over the two periods. On a positive note, terminals and related businesses have consistently performed well, with significant revenue growth and profit margins in both periods. In contrast, other segments have struggled, posting losses in both periods. The magnitude of these losses remains relatively stable, indicating that the underlying issues may be persistent. Overall, the company's performance is bifurcated, with some areas thriving while others continue to underperform. Management is emphasizing the company's strategic direction, focusing on core business growth while improving operational efficiency and global competitiveness. 3 key strategies are being implemented: optimizing port layout through strategic guidance, deepening operational synergy through lean operations and digital marketing, and strengthening network aggregation to enhance comprehensive service capabilities. The company aims to achieve a significant environmental goal by becoming carbon neutral by 2050, reducing emissions in the process. To drive this initiative, management is prioritizing customer needs, co-developing low-carbon solutions with partners, and driving technological innovation. Furthermore, the company is adopting ESG principles in operational management to achieve a triple win from economic, social, and ecological perspectives. Overall, management's outlook emphasizes a commitment to sustainability, customer centricity, and strategic growth, positioning the company for long-term success while minimizing its environmental footprint. Concerns have been raised regarding inventory buildup and supply chain disruptions in certain regions. A notable example can be seen in the southeast coast and other areas, where a significant decline in total throughput has been observed. According to available data, there is a -6.3% year-over-year YoY decrease in total throughput in these regions. This decrease in throughput raises concerns about potential inventory buildup and supply chain disruptions. The impact of such disruptions can be far-reaching, affecting not only the affected region, but also the broader economy. It is essential to monitor this trend closely and take proactive measures to mitigate any potential consequences. That concludes the financial summary for Cosco Shipping Ports Limited. Feel free to comment below, and I will be happy to answer them when possible.